When it comes to wealth-building strategies, there are two investment options that stand out: stocks and real estate. Both have their distinct advantages and risks, making them attractive options for different types of investors. The question many investors face is, which one should I put my money into? In this video, we will dive into an in-depth comparison between stocks and real estate, breaking down the key aspects of each asset class. By the end of this video, you will have a clearer understanding of where to place your hard-earned capital based on your personal financial goals, risk tolerance, and time horizon. Understanding stocks. Stocks represent ownership in a company. When you purchase a stock, you become a partial owner of that company and have a claim on its assets and earnings. Stocks can be bought and sold through stock exchanges, with the price fluctuating based on a variety of factors including company performance, market sentiment, and macroeconomic trends. Stocks are generally seen as a high-risk, high-reward investment. The prices of stocks can fluctuate dramatically over short periods of time, making them potentially volatile. However, they also offer the potential for substantial returns, especially over the long term. Historically, the stock market has provided average annual returns of around 7 to 10%, adjusted for inflation. One of the primary ways investors make money with stocks is through capital gains and dividends. Capital gains are realized when a stock is sold for more than it was purchased for. Dividends, on the other hand, are periodic payouts from a company's profits to its shareholders. While not all companies pay dividends, many established companies do, offering investors a steady stream of income. The key to investing in stocks is understanding market psychology and economic indicators. Stocks can be affected by a variety of external factors, including inflation, interest rates, and geopolitical events. Additionally, stock prices are influenced by market sentiment, meaning that investor perception can sometimes drive prices higher or lower than fundamentals would suggest. Real estate investments. The basics. Real estate investment involves purchasing property with the intention of generating income or capital appreciation. Real estate can be residential, commercial, or industrial, and it offers a wide range of investment opportunities, from buying rental properties to investing in real estate investment trusts, REITs. Real estate is often viewed as a more stable, long-term investment compared to stocks. The value of real estate typically appreciates over time, although this is not always guaranteed. Historically, real estate has provided consistent returns, making it an attractive option for those looking for more security in their investment strategy. One of the major benefits of real estate is the ability to generate passive income through rental properties. By purchasing properties and renting them out, investors can receive a consistent stream of cash flow. In addition, real estate offers investors the potential for significant tax advantages, including deductions for mortgage interest, property taxes, and depreciation. Real estate investments can also be leveraged, meaning that investors can borrow money to finance a portion of the property purchase. This allows for the possibility of higher returns since investors are using other people's money to finance part of their investment. However, leverage can also increase the risk, as it magnifies both the potential for gain and the potential for loss. The risk factor. Stocks versus real estate. One of the most significant differences between stocks and real estate is the level of risk involved. While both investment classes carry risk, the nature and degree of that risk vary. Stocks are typically more volatile than real estate. A sharp drop in the market or a sudden downturn in a company's performance can lead to significant losses in a short period of time. For example, during periods of economic downturn or financial crisis, stocks can experience steep declines, as we saw in 2008 when the global financial crisis wiped out trillions of dollars in market value. Real estate, on the other hand, is generally seen as a more stable investment. While property values can fluctuate, they do not typically experience the same level of volatility as stocks. Real estate markets are influenced by different factors than stock markets, such as interest rates, supply and demand, and location-specific factors. In addition, real estate investors have more control over their investments, allowing them to make decisions about property management, upgrades, and pricing strategies. However, real estate does come with its own set of risks. Property values can decline due to factors like neighborhood decline, natural disasters, or economic downturns. Additionally, real estate investments require significant upfront capital, and investors must factor in ongoing costs like property taxes, maintenance, and insurance. Liquidity. Stocks versus real estate. Another important factor to consider when deciding between stocks and real estate is liquidity. Liquidity refers to how quickly an asset can be converted into cash without significantly affecting its price. Stocks are highly liquid. You can buy or sell shares of stock in a matter of seconds through a brokerage account. This makes stocks an attractive option for those who may need to access their money quickly or who want the flexibility to adjust their portfolio at any time. However, the liquidity of stocks can also be a double-edged sword. Because stocks can be sold quickly, they can also be bought quickly, leading to impulsive decisions that may not align with your long-term investment goals. Real estate is far less liquid. Selling a property can take months, and during that time, the value of the property can change. In addition to the time required to find a buyer, there are also closing costs, legal fees, and other expenses that must be factored into the sale. This lack of liquidity can be a disadvantage for investors who need to access cash quickly, but it can also be an advantage for those looking for a more long-term, stable investment. Capital appreciation. Stocks versus real estate. Both stocks and real estate offer the potential for capital appreciation, which refers to the increase in the value of an asset over time. However, the rate of appreciation can differ between the two asset classes. Stocks typically offer higher potential returns over the long term. Historically, the stock market has outperformed most other asset classes, including real estate. A well-diversified portfolio of stocks can generate significant capital appreciation, especially if you are able to buy and hold investments for a long period of time. Real estate, on the other hand, tends to appreciate more slowly, but it often provides a more predictable and steady rate of growth. Real estate investors may experience lower overall returns compared to stocks, but they also benefit from the stability and long-term growth that property investments can provide. Income generation. Stocks versus real estate. Income generation is another critical factor to consider when comparing stocks and real estate. Both stocks and real estate can generate income, but the nature of that income is different. Stocks can provide income through dividends, which are periodic payments made to shareholders. These dividends are typically paid out quarterly, although the amount can vary depending on the company's profits. While dividends provide a reliable source of income for some investors, they are not guaranteed. Companies may choose to reduce or eliminate their dividend payments if they experience financial difficulties. Real estate provides income primarily through rental properties. By purchasing properties and renting them out, investors can receive a steady stream of cash flow. This can provide more consistent and reliable income than dividends, especially if you own multiple rental properties. However, rental properties come with additional responsibilities, such as property management and maintenance, which can eat into your income. Tax considerations. Stocks versus real estate. Taxes play a crucial role in determining the overall return on any investment. Both stocks and real estate have unique tax advantages and disadvantages. In terms of stocks, dividends are typically subject to taxation. The tax rate on dividends can vary depending on your tax bracket and whether the dividends are classified as qualified or non-qualified. Capital gains are also taxed, but the rate may be lower for long-term gains, on assets held for over a year, than for short-term gains. Real estate, on the other hand, offers several tax advantages. For example, property owners can deduct expenses related to property management, maintenance, and mortgage interest from their taxable income. In addition, real estate investors can take advantage of depreciation, which allows them to reduce their taxable income by claiming a deduction for the gradual wear and tear of the property. However, when the property is sold, investors may be subject to capital gains taxes on any appreciation in value. Final thoughts. Stocks versus real estate. The decision between investing in stocks or real estate ultimately depends on your individual financial goals, risk tolerance, and time horizon. Stocks offer higher potential returns and greater liquidity, making them a good choice for investors looking for growth and flexibility. However, they come with higher volatility and risk, especially in the short term. Real estate provides more stability and the potential for passive income, making it an appealing option for investors looking for a long-term investment. However, it requires more capital, is less liquid, and involves more hands-on management. Both stocks and real estate can play important roles in a well-diversified investment portfolio. By understanding the unique characteristics of each asset class, investors can make more informed decisions about where to put their money.